The moment your portfolio hits $1 million, the Securities and Exchange Commission reclassifies you, not metaphorically, literally on paper, in a legal document. You become an accredited investor under Regulation D of the Securities Act of 1982. And that designation unlocks an entire category of investment products that are explicitly off limits to everyone else. Not because you suddenly got smarter, because you have the money. That is the first thing that changes, and it is far from the last. Most people think crossing $1 million is just about a bigger number. It is actually about entering a different version of the financial system, one that has been quietly operating parallel to the one you've been using your whole life, with better returns, different rules, and a tax code that works in reverse from the one you know. Today I'm going to show you exactly what that system looks like, why it exists, and how to position yourself to use it before you cross the line. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data link in the description. I want you to picture a rocket sitting on a launch pad. You pump in fuel, you ignite the engines. The rocket strains against gravity. It burns through enormous energy just to get off the ground. And then at a very specific speed, roughly 25,000 miles per hour, something changes. Earth's gravitational pull can no longer bring the rocket back down. Physicists call this escape velocity. Below that speed, the rocket fights gravity every single second it is airborne. Above it, the rocket is free. It does not need to keep burning fuel to stay in space. It just goes. That is exactly what happens at $1 million invested. Below that number, you are burning fuel every month. You need income from a job, a business, a client, something external to keep your financial life airborne. Your money is working, but it is not enough to escape gravity on its own. At $1 million, you hit escape velocity. The returns your portfolio generates, even in a bad year, even in a flat year, start to exceed what most people earn working full-time. And the system around you, the legal system, the banking system, the investment product system, all of it recognizes that you are no longer on the launch pad. You are in orbit. Different rules apply in orbit. I am going to come back to this rocket idea throughout the video, because it also explains the single most dangerous mistake people make right after they cross the threshold. But first, let me show you why the math alone should make you question everything you think you know about building wealth. In a few minutes, I am going to show you the specific legal doors that open at exactly $1 million doors that most financial content on the internet never mentions. But first, let me show you why the math below $1 million is fundamentally broken in a way that explains why this threshold matters so much. Here's the thing about compounding that nobody actually teaches you. It does not scale linearly. It accelerates. Not in a vague inspirational poster way, in a cold, concrete numbers on a spreadsheet way that will make you rethink how you allocate your time. Let me give you real numbers. You have $10,000 invested, S&P 500. Long-term average, roughly 10% nominal per year. Call it 7% after inflation. In 1 year, that $10,000 generates $700 in passive income. You worked 50 weeks to save that $10,000. You get $700 for doing nothing. Nice, symbolic, completely irrelevant to your actual life. You have $100,000 invested. Same return. That is $7,000 per year. A meaningful vacation, a car payment. Not life-changing, but you can feel it. You have $500,000 invested, 7%, $35,000 per year. Now we are talking. That is a real second income. Except, and here's what people miss, you are still not free. The Bureau of Labor Statistics Consumer Expenditure Survey for 2023 puts average American household spending at approximately $77,000 per year. $35,000 does not cover that. You still need your job. You are still burning fuel every month. $1 million, 7%, $70,000 per year. That is the number. That is the exact moment the math crosses the line. Your money, on its own, is generating close to what the average American household spends annually. Buy your money. working while you sleep. But here is where it gets genuinely interesting, and this is the part I almost never see covered. The acceleration does not stop at the threshold. It gets faster. Once you hit 1 million and you are still contributing, say you keep putting in $2,000 a month, which is meaningful but not unusual for someone who took 10 to 15 years to get there, the math becomes almost embarrassing. A 7% return on $1 million generates $70,000 passively. Your $2,000 monthly contribution adds another $24,000. You are adding roughly $94,000 to your portfolio every single year without doing anything heroic, without a viral side hustle, without timing the market, without a single clever trade. The rocket is already in orbit. Gravity is not the problem anymore. Your second million takes roughly half the time of your first. Think about what that means in terms of effort. You probably spent 10, 12, maybe 15 years grinding to get to 1 million, working, saving, investing, making boring choices that nobody posts about. And then the second million, 7 to 9 years. Third million, 5 to 6. The compounding math is not linear. It is a rocket that keeps accelerating after you stop adding fuel. Now here is the reversal I want you to sit with, because it is counterintuitive enough that most people reject it the first time they hear it. You think the problem is getting to 1 million, but actually the problem is knowing what to do in the 3 years before you get there. Let me tell you a quick story. There is a guy, call him Marcus. Marcus worked in pharmaceutical sales for 16 years. Decent income, nothing spectacular, disciplined saver. By 2018, he had $850,000 invested across a 401k and a brokerage account. 11 years of grinding. He could see the $1 million mark on the horizon, and then he panicked because he knew, or thought he knew, that something changes at 1 million. He had heard people talk about it, so he started getting conservative. He shifted his allocation from roughly 80% equities to 50% because he did not want a market crash to push him back. He wanted to protect what he had built. 2019 happened. The S&P 500 returned 31.5%. Marcus captured about 40% of that return. Because of his conservative shift, he got to 1 million in 2022 instead of 2020. He lost 2 years of being in orbit because he did not understand what he was actually protecting himself from. The math on that mistake? Roughly $140,000 in lost compounding, gone. Not because Marcus was dumb, because he was close enough to see the threshold and scared enough to flinch. The most dangerous part of any rocket launch is not takeoff. It is the last mile before escape velocity. That is where you run the highest risk of pulling back on the throttle at exactly the wrong moment. And while we are talking about things quietly destroying your progress fees, most people hear a 1% annual fee adds up over time and nod vaguely and do nothing. Let me make it specific. You have $200,000 invested. You are paying 1% per year in fund management fees versus a Vanguard index fund that charges approximately 0.03% after 30 years at a 7% gross return. The high fee version leaves you with approximately $1.15 million. The low fee version, approximately $1.5 million. The difference is about $350,000. On a starting balance of $200,000, at $1 million, the same calculation produces a difference of roughly $1.75 million over 30 years. $1.75 million. In fees that you paid for someone to underperform an index fund that a computer runs for $3 per 10,000 invested. That is not fees add up. That is fees eating your retirement while wearing a nice blazer and calling it financial planning. Now here is what nobody is telling you, and I genuinely mean nobody, because the financial services industry has a very strong incentive to not explain this clearly. When your net worth, excluding your primary residence, crosses $1 million, or when your income exceeds $200,000 for 2 consecutive years, the Securities and Exchange Commission formally reclassifies you as an accredited investor under Regulation D of the Securities Act. That legal designation unlocks a category of investment products that are explicitly unavailable to everyone below the threshold. Not hard to access, not expensive to access, legally prohibited. You cannot buy them. They're not on any platform you currently use. They do not show up on Fidelity or Schwab or anywhere your current money lives. So what is actually behind that door? Private equity funds, real estate syndications, hedge funds, private credit, structured notes, pre-IPO equity, and an entire asset class called private placements, which is how private companies raise capital before they ever touch a public exchange. Let me give you some numbers on why this matters. As an asset class, private equity has historically outperformed the S&P 500 by roughly 3 to 5 percentage points per year over long periods. That data comes from Cambridge Associates, which tracks institutional private equity returns across thousands of funds going back decades. 3 to 5 percentage points does not sound dramatic until you put it in a calculator. The difference between a 10% annual return and a 13% annual return on $1 million over 20 years is approximately $3 million. $3 million in additional wealth from the same starting capital because you had access to a different category of asset. None of that was available to you at $900,000. This is where it gets genuinely infuriating in a way I find more funny than enraging. The accredited investor rule was created in 1982, ostensibly to protect unsophisticated investors from risky, illiquid investments. The logic was wealthy people can absorb losses on speculative deals. Regular people cannot. So the SEC drew a line. The $1 million threshold has never been adjusted for inflation. In 1982, $1 million represented enormous purchasing power. In 2026, $1 million is what a modest house costs in a decent suburb of Denver. But the legal threshold has not moved. So the government is using a 44-year-old definition of wealthy enough to handle risk to determine who gets access to the highest returning asset classes available to private capital. That is the game. The rules are not based on fairness. They are based on what was written in 1982. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now here is the other side of that door, because I am not going to pretend everything behind the accredited investor wall is gold-plated. Private equity is illiquid. You are locking capital up for 7 to 10 years with no exit. Private credit funds charge fees that make your 1% mutual fund look like a charity. Hedge funds, as a category, have underperformed the S&P 500 over the last 15 years, according to SPIVA's annual scorecard, with some notable exceptions that you will not easily access anyway. The access is real. The quality of what you access requires serious diligence. The point is not that everything behind the wall is great. The point is that you now have the choice. And you can use that access selectively, the way institutional investors do, rather than being excluded from the conversation entirely. Vanguard does something less dramatic but worth knowing. When you have $1 million in assets across your Vanguard accounts, you qualify for Vanguard flagship services. Free access to a dedicated financial planner, reduced transaction costs, access to lower expense ratio, share classes on funds you already own. The annual savings in expense ratios alone at $1 million amounts to roughly $1,000 per year, every year, for as long as you stay in orbit. That is money your neighbor is paying that you stop paying because you crossed a threshold. You did not become a better investor at $1 million. The system changed around you. Here is a secondary thread I want to introduce because it is going to matter in a few minutes. There is a man I will call Dave. Dave is not a real person. Dave is every conversation I have had over the past several years with people who hit the $1 million mark, celebrated appropriately, and then made a predictable, expensive mistake in the 12 months that followed. Dave is real the way a warning sign is real. Dave hit $1 million in his brokerage account in early 2022. He was 43. He had been disciplined and boring and consistent. Maxed his 401k every year since his late 20s. Low-cost index funds. Did not panic in 2008. Did not panic in 2020. Dave was, by every measure, a textbook long-term investor. And then his portfolio crossed $1 million. And something in his brain shifted. I will come back to Dave. Because what happened next is the most common and most expensive mistake people make right after they hit escape velocity. And it has nothing to do with picking the wrong stocks. Stay with me, because this next part changes everything you think you know about what gets harder after you cross the threshold. Here's the assumption most people carry into their first million. More money, less stress. You hit the number, the anxiety comes down, you relax into wealth. Here's what actually happens. The anxiety does not disappear. It changes denominations. When you have $50,000 invested, a 10% market drop costs you $5,000. It stings. It might affect a planned renovation, but it does not threaten your life. When you have $1 million invested, a 10% market drop costs you $100,000 in a single quarter or a single week. The S&P 500 dropped approximately 34% in 33 days between February 19th and March 23rd of 2020. If you had $1 million invested on February 19th, you woke up on March 23rd with $660,000. That is $340,000 gone in a month. $340,000 is more than the median American household earns in 5 full years. The market recovered. By August of 2020, the S&P was back at all-time highs. If you did nothing, you were fine. But the psychological weight of watching a 6-figure loss accumulate in real time, checking your portfolio and seeing numbers that represent years of your actual life evaporating, that is a fundamentally different experience than watching a smaller number fluctuate. This is where behavioral economics becomes critical, and where most financial advice completely fails people approaching the threshold. Daniel Kahneman, who won the Nobel Prize in economics in 2002, spent his career documenting how humans actually make financial decisions versus how the models say they should. His work on loss aversion, the finding that humans feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain, is the single most important concept in personal finance that almost nobody applies correctly. At $50,000 in a portfolio, loss aversion is manageable. The numbers are not large enough to trigger irrational behavior in most disciplined people. At $1 million, loss aversion becomes a genuine threat to your wealth. Here is how it plays out in the real world. Your portfolio is at $1 million. The market drops 15%. You have lost $150,000 on paper. Your brain, not the rational part, the ancient part that was designed to detect predators and avoid sudden loss. Your brain screams that something irreplaceable is being taken from you and that you should act now to stop the bleeding. So you sell. You move to cash or bonds or gold. And you do it at exactly the wrong time, because market bottoms are by definition the moments of maximum psychological pain. The worst moment to sell is when selling feels most necessary. This is what happened to Dave. When Dave's $1 million became $820,000 in September of 2022 during the Federal Reserve's aggressive rate hiking cycle, he did something he had never done in 15 years of investing. He sold. Not everything, but he moved 40% of his equity positions into money market funds. I want to protect what I have built, he said. A completely rational feeling. A completely catastrophic timing. The S&P 500 bottomed on October 12th, 2022. Dave moved his money in late October, right after the bottom. He missed the partial recovery into year end. He stayed mostly in cash through 2023, which returned 26%. He got back in gradually through 2024. By the time he was fully reinvested, the market had already done most of its work without him. Dave did not make a stupid decision. Dave made a human decision. But human decisions are expensive at $1 million in ways they are not at $100,000. The guy who had $200,000 in his brokerage account spent 0 time checking it on vacation. The guy with $1 million checked it 8 times before breakfast. That is not discipline. That is escape velocity with a broken navigation system. The people who stay wealthy after crossing the threshold are not the ones who feel no emotion about market swings. They are the ones who have built systems that prevent emotion from triggering action. Written investment policy statements, automatic rebalancing with defined thresholds, fee-only advisors not commission-based specifically tasked with talking them off ledges during drawdowns. These are not signs of emotional weakness. They are navigation architecture. And in orbit, navigation matters more than engine power. The brutal irony is that the discipline that gets you to 1 million, the hyper attention to every dollar, the obsessive tracking, the grinding optimization is actually counterproductive, above the threshold. Being hyper vigilant about your portfolio is how you accumulate. It is also how you accidentally destroy wealth you have already built. The system trained you to fight gravity, but you are in orbit now. Fighting is the wrong response. A financial advisor I know put it this way: my job below 1 million is to help people get there. My job above 1 million is to protect them from themselves. That is not cynical, that is accurate. And it is worth knowing before you cross the line, not after. Now, here's what most financial content on this topic will not go near, because it requires you to have an actual tax attorney or CPA to execute correctly. But you should absolutely know it exists, because this is where the wealthiest investors quietly make an extra layer of return that has nothing to do with picking better assets. The tax code above $1 million in invested assets is a completely different document than the one you have been working with. Not because the statutory rates are dramatically different, they are not, but because the optimization strategies that become worthwhile above the threshold are worth tens of thousands of dollars per year, and below it, they do not produce enough savings to justify the complexity. Let me walk you through the three that actually matter. First, tax loss harvesting at scale. Tax loss harvesting is not complicated. When you have positions in your portfolio that are down and at $1 million, during any meaningful volatility, you always have some, you sell them, lock in the loss for tax purposes, and immediately buy a similar but not identical security to maintain your market exposure. The IRS lets you use those losses to offset capital gains dollar for dollar. If losses exceed gains, you can deduct up to $3,000 annually against ordinary income, with the remainder carrying forward indefinitely. At $50,000 invested, this strategy produces maybe a few $100s in annual tax savings, not worth the operational overhead. At $1 million during a volatile year, you might have $40,000 to $60,000 of harvestable losses available across your portfolio. If you are in the 15% long-term capital gains bracket, which applies to married filers with taxable income up to approximately $583,000 in 2026, you have just avoided $6,000 to $9,000 in taxes in about 20 minutes of trades. That is more than what many Americans earn in 2 months at their actual jobs. For 20 minutes of rebalancing work, using a rule that has existed in the tax code for decades, and that most people below $1 million simply cannot use effectively because the numbers are too small to make the math worthwhile. Second, asset location. This one is subtle, but the annual impact is real. You have money in a taxable brokerage account and money in a tax-advantaged 401k or IRA. Most people hold roughly the same allocation in both a diversified mix of stocks and bonds. That is leaving money on the table. The optimal strategy, which both Vanguard and Fidelity have published extensive research supporting, is to hold your least tax-efficient assets inside your tax-advantaged accounts and your most tax-efficient assets in your taxable account. Specifically, bonds, REITs, and high turnover funds generate interest income and short-term capital gains, taxed as ordinary income. Those belong inside the 401k, sheltered from annual taxation. Low turnover equity index funds, which generate mostly long-term capital gains and qualified dividends taxed at lower rates, can live in the taxable account without significant drag. At $100,000 total invested, the annual benefit of optimal asset location is roughly $500 to $800. Meaningful, but not transformative. At $1 million, the annual benefit runs $5,000 to $8,000 every year, compounding for as long as your portfolio stays in orbit. Third, qualified opportunity zones and charitable giving structures. I am going to keep this one high level because executing it correctly requires a tax attorney, but you should know it exists before you suddenly have a major gain event. When you sell an appreciated asset, say you bought something years ago for $100,000 and it is now worth $400,000, you owe capital gains tax on $300,000 of gain. In the 15% bracket, that is $45,000. Above certain income levels, there is also a 3.8% net investment income tax on top of that, bringing your effective rate to 18.8% on investment gains. That is $56,400 out the door on a single transaction. A qualified opportunity zone investment lets you defer and in some cases reduce that liability by reinvesting the gains within 180 days into a designated opportunity zone fund. A donor-advised fund lets you donate appreciated securities directly, claim a deduction at fair market value, and legally never pay the capital gains tax at all. The charity gets the asset. You get the deduction. The IRS gets nothing from the appreciation. Below $1 million in investable assets, these structures almost never make economic sense. The legal and accounting overhead eats the benefit. Above it, they can save you decades of compounding on money that would otherwise transfer to the federal government in a single check. And here's the part that most people miss entirely. The part that genuinely annoys me in a low-grade way when I think about it. The wealthy do not actually pay dramatically higher tax rates on their wealth accumulation. They pay dramatically lower effective rates. Because the tax code is structured to reward capital formation, specifically at the scale where capital formation can actually happen. Every optimization I just described is legal, documented, and available to anyone who crosses the threshold. The system is not hiding this. It is in the tax code. It is in the prospectuses. It is in public SEC filings. It is written in language designed to be unreadable to people who do not have accountants on retainer. That is the kicker. Not that the wealthy have some secret. It is that the system was designed around the assumption that wealthy people have professionals reading the fine print. And below $1 million, you probably cannot afford the professionals whose fees are justified by the savings. The government. We have tax incentives specifically designed to help investors above certain asset thresholds retain more of their compounding returns. Also the government. We have not meaningfully updated financial literacy curricula in public schools since the Reagan administration. Let me make this real with a specific scenario. Sandra is 41 years old. She earns $115,000 per year as a senior project manager at a mid-sized tech company. She has been investing consistently since she was 28. Right now, she has $820,000 distributed across a 401k, a Roth IRA, and a taxable brokerage account. She maxes out her 401k at $23,000 per year, contributes $7,000 to her Roth, and adds approximately $900 per month to her taxable account. She is not a millionaire yet. At her current savings rate and historical average returns, she is roughly 11 months from crossing the threshold. Here's what I would tell Sandra to do right now before she gets there. The first thing is to audit her asset location immediately. She is currently holding a total bond market index fund inside her taxable brokerage account. That fund generates ordinary interest income taxed at her 22% marginal rate every year, regardless of whether she sells anything. Moving that fund inside her 401k and replacing it with a low-cost equity index fund in the taxable account would eliminate that annual tax drag. The annual savings, approximately $3,200, starting now, growing as the portfolio grows. That is a round-trip flight to Europe every year that she is currently handing to the IRS for no strategic reason. The second thing Sandra should do is start her accredited investor education today, not the day she qualifies. Her total net worth likely already meets the threshold if she has any home equity. She should be reading the structures, what private credit is, what a real estate syndication actually involves, what the fee structure of a private REIT looks like, so that when the door opens legally, she's not walking in cold. The investors who get burned by accredited products are the ones who treat qualification as a prize. The ones who use access well are the ones who showed up prepared. The third thing, and this is the one that will matter most in the near term, is that Sandra needs to write her transition plan before she crosses the threshold, not after. She needs to decide on paper today what her target allocation will be on the day her portfolio crosses 1 million. What would justify changing that allocation and what conditions would have to be true for her to sell anything. A written investment policy. Not because her current strategy is wrong, because the psychological pressure of having $1 million exposed to market risk is qualitatively different from the pressure at 800,000, and human beings consistently make their worst financial decisions in the first 12 to 18 months after hitting a major milestone. She needs the navigation system installed before she hits escape velocity. Sandra is 3% away from orbit. The question is not whether she gets there. The question is whether she has the architecture ready for what comes next. Back to Dave. By 2025, Dave had rebuilt. His portfolio sat at approximately $1.3 million less than it would have been without the cash move in 2022, but back in orbit. In the past year, he did something important. He hired a fee-only fiduciary financial planner, not someone compensated by commissions or fund referrals, but a flat-fee advisor whose only financial incentive is his client's long-term outcome. Together, they wrote a 3-page investment policy statement that explicitly prohibits Dave from making allocation changes during market drawdowns of less than 25%, and that requires a mandatory 48-hour waiting period before any rebalancing decision during high volatility periods. Dave told someone I know that having that document was worth more than the advisor's annual fee. Not because the document said anything Dave did not already know intellectually. Because it gave him permission to do nothing in the moments when his lizard brain was screaming at him to act. The system took the decision out of his hands in the moments when his hands were the problem. Dave's rocket is in orbit. The navigation system is on. He does not have to fly it manually through every turbulence event anymore. That is the real transformation. Not the accredited investor access, not the compounding acceleration, not the tax optimization. All of those are real and they matter. But the most durable thing that changes at $1 million is whether you have the structural architecture to survive being there. So let me leave you with 3 things that are specific to this exact threshold and nothing else. 1, build your transition plan before you cross the line. Decide your target allocation, your rebalancing rules, and the specific conditions that would actually justify a change in writing before you get there. If your rule is, I will only change my equity allocation if we see a drawdown exceeding 30%, sustained for more than 90 days, and I believe the economic disruption is structural rather than cyclical, write that sentence down. The document is your navigation system. It exists for the moments when your brain wants to override the math. 2, audit your tax location this week. Open your brokerage account and your 401k. Look at what you are holding where. Anything generating ordinary income bond funds, REIT funds, high dividend equity funds belongs inside the tax advantaged account. Anything that generates qualified dividends and long-term capital gains, low turnover, broad equity index funds can live in the taxable account. This is not a complex restructuring. It is an afternoon of rebalancing that compounds quietly for decades. 3, learn what you are about to qualify for before you qualify for it. Read the SEC's definition of an accredited investor. Look at what private credit actually is and how the fee structures typically work. Research what a real estate syndication involves operationally. Not because you should immediately invest in these the day you cross the threshold. You should not. But because the investors who use accredited access well are the ones who spent 6 months studying what is on the other side of the door before it opened. The ones who get burned are the ones who walked in treating qualification like a lottery win. The threshold is real. The changes are documented. The question is whether you hit them with a plan or with a feeling. Lazy investing built more fortune than crypto memes. And the laziest, most leverage maximizing, lowest effort thing you can do right now is build the system before you need it, get out of the way, and let the rocket fly. The market does not care how hard you work to get there.